Welcome to The Explainer. Today we're tearing down the hood on one of the most powerful wealth building engines on the planet. We're going to track how real estate actually makes money, following a single dollar from a literal patch of dirt all the way to massive scaled dividends. Let's get right into it. Okay, let's dive into this. Here is our roadmap to follow the life cycle of a real estate dollar. We'll start with the foundation, move into building and selling, explore the rental cash flow engine, uncover hidden wealth, get a reality check on the real risks, and finally, look at scaling the empire. Starting with Phase 1, the foundation of real estate. We're talking dirt, rules, and borrowed money because, every incredible real estate fortune fundamentally starts with the literal ground we walk on. Now, you might be wondering, why is land so expensive? Well, a random patch of dirt isn't inherently valuable just because it exists. Its price tag is completely dictated by its surroundings, access to roads, electricity, that sort of thing. But here is the real secret: zoning laws. The specific legal rules of what you're actually allowed to build ultimately determine that land's potential. It's wild. Almost like a magical pen stroke, a simple change in zoning rules can skyrocket a property's value before a single shovel even hits the dirt. You might think you need millions in cash to even get started. Actually, scratch that. Not quite. Enter leverage, literally the ultimate financial amplifier in real estate. Instead of paying entirely with your own capital, you combine a much smaller amount of your own money with bank loans and investor funds. Doing this lets you control a much larger, way more expensive asset than you ever could alone. Now, what's really interesting about this slide is the massive contrast between these two approaches. Buying with 100% of your own cash. It's safe, you have very low financial risk, but you severely limit your purchasing power. Using bank money completely flips the game. You control larger assets and amplify your returns, but, and this is a big but, you also dramatically amplify your risks, especially when that debt gets expensive. Think of a cash-only deal like a safe, moderate return, nice and steady. But leverage? Man, that's a financial rocket ship. Borrowing money can absolutely skyrocket your returns, turning a good deal into a genuinely great one. However, the higher you go, the closer you get to the sun. If your project faces delays or interest rates suddenly climb, that expensive debt can consume your profits just as fast as it made them. That brings us to Phase 2, building, marketing, and selling. This is the high-stakes game of development, where the land and the financing we just talked about are finally put to work. Let's trace the hero's journey of a developer's dollar. Step 1, secure the land and those crucial zoning rights. Step 2, obtain the massive financing required to pull it off. Step 3 is the heavy lifting, managing construction, materials, and contractors to transform that empty land into a valuable property. And finally, Step 4, market and sell. A beautiful building doesn't guarantee buyers without strong advertising and real demand creation. Fascinatingly, developers often don't even wait for the paint to dry. They use pre-sales to get cash flowing early, with buyers actually reserving properties by paying deposits while construction is still happening. This is a brilliant way to fund the build and keep those costly bank loans to an absolute minimum. But it's a double-edged sword for sure. Taking that early money creates strict, unyielding obligations for the developer to finish the project and deliver exactly what was promised. All right, let's shift our narrative in Phase 3. The rental cash flow engine. For a lot of investors, moving away from risky one-time sales and toward recurring long-term cash flow is the absolute holy grail. So different commercial spaces generate revenue in totally different ways. Commercial offices rely on location and keeping occupancy high with multi-year leases. Honestly, an empty office is basically a black hole for your wallet. Retail stores rely heavily on customer foot traffic. If people aren't walking by, retailers simply can't pay the rent. But industrial warehouses operate differently. A warehouse situated near a major highway or a port is a true logistics gold mine, leading to incredibly stale long-term leases, because companies invest heavily in those spaces and tend to stick around for years. Beyond that monthly rent check, we enter Phase 4, hidden wealth and appreciation. This is the magic of passive wealth, where properties quietly make you rich simply by existing over time. Let's move to and see how this builds across a property's timeline. In year 1, you make your initial purchase. By year 5, you're likely seeing natural market appreciation. The city grows around the property, populations increase, and your land naturally becomes more valuable. But year 10, that is where savvy investors force value. By actively renovating the building, upgrading amenities, and keeping vacancies super low, they drive the property's value aggressively higher, completely independent of the broader market. And this brilliantly illustrates the quiet, almost magical power of real estate math. Equity is simply your property's total value minus the debt you still owe. Every single month, a tenant pays you rent, and you use a portion of that to pay down your mortgage. The loan balance falls while the property value potentially rises. Secretly, your tenant is building your net worth for you, month after month, expanding your share of the asset. And here is the best part. You don't even have to sell the property to enjoy this newfound wealth. When the value goes up, investors can simply refinance. They take out a new, larger loan to pay off the old one, and they pocket the difference in cash. This gives you tax-free capital to fuel your next big real estate move, all without losing your asset or your reliable monthly cash flow. But listen, we can't just talk about the fun stuff. It's time for our Eat Your Vegetables moment. In Phase 5, the real risks involved. Let's balance all this wealth talk by exploring the harsh, often very expensive realities of property ownership. Owning property means constantly fighting hidden expenses. You've got property and income taxes eating into your profits, you've got routine maintenance, unexpected disasters like storms that require really robust insurance, and economic cycles that can completely crush demand. But the absolute ultimate danger is vacancy. The exact second a tenant leaves, your rental income stops completely. But your mortgage payment, taxes, and insurance, those absolutely do not. What you should really take away from this explainer is that successful real estate isn't just about the thrill of buying a shiny new building. It's heavily about anticipating disaster. Smart property owners budget for repairs way before the problems happen, because if you don't aggressively maintain and protect the physical building, you simply cannot protect the income and long-term value it's supposed to produce. Another major external risk is the broader economy, specifically interest rates. It's a really delicate economic seesaw. When rates are lower, loans are cheaper, buyers can afford more, and prices naturally rise. But when interest rates shift higher, financing costs spike, your monthly cash flow gets drastically reduced, and property prices are often pushed down simply because buyers can afford less. Which brings us to the climax of our explainer in Phase 6, scaling the property empire. This is how the most successful investors take every single concept we've covered today and simply hit repeat. Scaling an empire is all about momentum. That accumulated cash flow and the equity you pull from refinancing provide the massive capital needed to purchase your second property, and then your third. But make no mistake, this requires a massive shift in mindset. You really have to transition from being a DIY weekend landlord to running a professional business, relying heavily on expert property managers to handle the exponential growth in maintenance, tenant issues, and financial complexity. But what if you don't want to deal with property managers or fix leaky pipes at 2 a.m.? Well, enter the REIT, or Real Estate Investment Trust. This is a brilliant, totally hands-off solution. A REIT pools money from thousands of everyday people to buy massive income-producing properties. They collect the rent, and a portion of that income flows directly back to you as a shareholder in the form of a dividend. You get a slice of real estate wealth without ever touching a hammer. The whole shebang. So, the crucial point is this. We've seen how real estate is a true, undeniable wealth-generating machine. It uses leverage to control assets, rent to create cash flow, and time to build immense equity. But it also demands that you strictly manage expensive debt, navigate crushing vacancies, and survive unforgiving market cycles. The machine works, there is no doubt about that. But the real question is, are you ready to balance all these forces to build your own empire?